Hey everyone, welcome back to Accounting with Kamo. In today's video, we are diving into a real exam question, the income statement from the Gauteng June 2025 paper. So if you're in grade 12, this is the perfect opportunity to actually test your skills and learn how to approach these questions in an exam setting. So grab your pen, your paper, and let's go step by step through the calculations, just like you do in the exam. So let's get into it. So now, we first have the 2025 question paper on the left, then here it's just the answer sheet that they'll give you on the right hand side, right? So now, the question obviously they're saying the statement of comprehensive income and statements of the financial position, right? So the first part I'm just going to leave it out. So we're going to just go straight into 1.2.1 whereby they say complete the statement of comprehensive income, which is your income statement for the year ended. This one is very important. I need you all to remember dates are very important when it comes to accounting. Dates are very important. So now when they're saying that the year is ending, it ended on the 28th of February 2025, it means that it started, right? So remember, if it ended on the 28th of February 2025, it started on the 1st of March when in 2024. So remember that part, right? Remember also the dates are very important. So the balance sheet will look at it in the future basically. I'll do a video on it on the balance sheet, but for now we're just going to focus on the income statement. So now, let's get into it now. So they're saying that note some amounts in the are provided in the answer book. As you can see, the cost of sales are given, the bad debts recovered, the salaries and wages, and the operating profit is basically given, right? So now they give us the balances and totals on the 28th of February 2025. Then obviously these are the balances that they give us. So I'm guessing these balances they would have balances that are gonna go in the balance sheet, and they also have balances that are gonna go in the income statement. So some of them here we're gonna ignore them, but I'll go one by one, and try to explain why one goes to the balance sheet and one and why we're gonna choose these ones for your income statement basically. All right. So now let's continue going down. So now they're saying note the bank balance is given on what? On the 24th of February 2025. So, and they also note that there were transactions conducted after the 24th of February 2025. Remember, if the bank balance is given on the 24th, right? But it ended on the 28th. So it means that anything that affects the bank balance after the 24th, it needs to be considered because now the year doesn't end on the 24th of February, but it ends on the 28th of February. So also note those things. Dates are very important, right? Then they say that the extract from the cash flow statement for the year ended 28 February 2025. We have the depreciation, the income tax paid, we have the interest paid, and we have the fixed deposit matured basically. And then here we have our adjustments and additional information right there. Um, and yeah, question two down there. Okay, so now let's just head straight into the income statement and see basically how we would go about this. So now, first things first, we're going to look at the sales. The sales is the first part on the income statement that we'll be dealing with. Remember, sales, it's either sales or your revenue, right? But since we are dealing with grade 12 right now, we're going to call it sales. So now, how would we get sales now from this question basically whereby we only given the cost of sales? So meaning that now we're going to come in the notes now, right? We're gonna come in the balances, the adjustments and the information that we're given. As you can see right here, the sales they're not given here. The sales are not given. That's why we have a question mark, right? So meaning that it should be somewhere in the adjustments. So let's look in the adjustment and see what they can tell us about the cost of sales, right? So now the first one it tells us about audit fees. We don't want that. Tenant. Then there was a stock purchase of by a stock purchase of 13,000. We don't want that. Then they say that 20% of the stock received was defective. The supplier acknowledged the error and issued credit note, but no entry has been made. We don't want that. Then they say that the physical stock count revealing trading stock and stationery used for the year. Don't want that. Customer, no, no, not that one, not that one too, not that one. Then now here, this is the one that we are looking for. They're saying that the operating profit on sale is what? It is 15%. The operating profit on sales is 15%. So first things first, we need to find the operating profit, right? We need to find the operating profit. So now we are given the operating profit on the right hand side. We are given the balance of the operating profit. It is 690 thousand, right? So meaning that here we're gonna have an adjustment of 690,000. Then you're going to multiply it by what? By 15%. Right, by 15, by not 15%, but you're gonna multiply it by 100 over 15, right? 100 over 15. Why are we doing that? Because the sales now, it has a certain amount, right? But that amount, the operating profit if is 15% of sales, right? So in other words here, if I can do the calculation of what I'm talking about, basically is that you'd have the amount of your sales, right? And that amount of sales, if you multiply it by the 50 by 15%, what do you get? You'd basically get um the 690,000, basically, right? You get the 690,000. But now if you're looking for the value of the sales, we're gonna divide by that 15%. And when you divide by the 15%, we definitely do know that 15% can be written as 15 over 100. So if you have 690,000 divided by 15 over 100, you know that obviously if you just remove this thing, if you just remove the division and you multiply it, and remember when you multiply, you're gonna do the inverse of the fraction. So you're gonna say times 100 over 15, basically. So that's how we got the 690,000 times 100 over 15. So I hope that part makes sense there. Then for our answer right there, we're gonna get 4,600,000. So you're gonna get 4,600,000. So I hope that calculation made sense right there. So make sure that you remember how we would calculate these things. So I'm just going to erase it because I know there are going to be other adjustments that I'm going to need space for, but I hope you copied that down. You just pause the video, then copy the calculation down. Then now let's continue now to what's next. So since we are given the cost of sale, we basically are going to what? We are going to skip the cost of sales because that one is already calculated. Then now the gross profit and the other operating income, we do not need to calculate them since they have these dark spots on them. So meaning that we do not need to calculate them, right? Bad debts recovered, we are given. So now, what I can tell you is that remember what I said about the layout in our last video. I said it's our sales, our cost of sales, gross profit. Then after that, we have other operating income. With your other operating income now, it's the income that we receive, right? So meaning that now we need to go to our adjustments, or we need to go to the trial balance and see what is our income and what is our income, so that we can come and what and register those transactions there, right? So now let's do that. And remember, before we go through with this, remember a income statement, it goes for 12 months, which is a whole year, right? It goes for 12 months. So don't make the mistake of forgetting that some amounts you need to divide them by 12 for you to get the value for 1 month. But for some, they'll tell you that it was not a year, but it went for 10 months. And if it went for 10 months, you divide it by 10 for you to get like the singular amount for that month, right? But let's just continue and look at the income. Ordinary share capital, it's definitely not part of the income statement. Retained income, not part of it. The loan, it's not part. Sales income tax, now this one is part, so I'm just gonna put a star on it because it is very important. Sales income tax, it is. Creditors control, no. Shareholders for dividends, no. Debtors control, this is definitely not. Provision for bad debts, it does include, because remember, I gave you the adjustments in the last video. I'll put the link in the description below so that you can check out the types of adjustments that we have in the income statement. Then trading stock is not part of it. Creditors for salaries, it only is in the balance sheet, so we don't have it. Then they say that the bank unfavorable as of, so this one also goes in the balance sheet. But the sales, the cost of sales, salaries and wages, audit fees, bad debts recovered, directors fees, rent, income, stationery, these ones now, these ones are the ones that are definitely are going to come in the um income statement, right? Sorry. So those ones are the ones that are gonna come in the income statement. So we're gonna look at them one by one and see what we can get out of them. So we already done with the sales. sale is done. Cost of sales is already given for us, right? So now let's look at the ones that are incomes right here. So salaries and wages, we know it's an expense. Audit fees, audit fees is an expense. Bad debts recovered. It depends, right? Bad debts recovered. Obviously, for from this one, bad debts recovered is what is an income because bad debts are recovered. So meaning that people that we thought were not gonna pay have paid, right? So as you can see there, but we are given the amount there, so there's no need for us to record it because we are given. So the first income we done with it. Director's fee, expense, rent income. Rent income, we have it there. There we have it, rent income. So the first one that we're gonna have is rent income. But now, I want you to remember something. I want you to remember something. You need to come and look at the adjustment if whether there's an adjustment on rent. And now let's look at the rent and see if it does. If you can look at number two, or Roman number figure two, you have the tenant occupied part of the premises since the 1st of April 2024. Now, listen to this. I said the year began on the 1st of March of 2024, right? And it ended on the 28th of February on 2025. And they're saying that the tenant occupied the premises on the 1st of April 2024. He has not paid the rent for January and February 2025, and the rent was reduced by 10% on September. I know it sounds undoable and it sounds confusing. When you're sitting in that exam room, it looks difficult, but I'm gonna give you a way on how to do this, right? Now, look at this. So obviously, if now we are given what? If now we have that the rent income value, but you know that it started on the 1st of April 2024, right? So now, obviously, it means that now the months that we have for this rent, it's 11, right? It's 11 months in total because it goes from the 1st of April 2024 up until the 28th of February 2025, right? Because the March rent is not included because this person started staying on the 1st of April, so they started paying rent for April, then continuing, right? So meaning that we're gonna have 11 months for rent. So we have 11. Remember that we have 11. But now they're saying that the rent for Jan and February was not paid, so 2 months are not paid. So now, if 2 months are not paid, how much do you have now? It means that now we're gonna have 9 months now in total. We're gonna have 9 months in one in total. So you're gonna have nine. But now from the nine, they're saying that the rent was reduced by 10% on the 1st of September. So now you start counting. This person means that they paid the normal rent on April, May, June, July, August. So for 5 months, they paid just 5x, right? X is just the amount of rent in that specific month, right? Then now we're gonna say what? September, October, November, December, right? Which is 4x. Now we're gonna have 4x, but now be careful of the next one. The next one is just 10, it's reduced by 10%. So if it's reduced by 10%, we're gonna have it being 4 into that x minus what? Minus the 10% of x because we are reducing it by the 10% of X basically, right? We are reducing it by the 10% of that month's rent. So now let's literally go and calculate the value and see how much you get. So I'm just gonna use the space right here. So the rent income, we are given the rent income as what? 107. So we have 107 500, right? So we have 107 500. That's the total rent for the 9 months. So remember the 9 months are given by what? The 5 months we paid normal rent, which is 5x, right? But now for the rest of the year or continuing, we have X, right? That rent was reduced by 10%. So you're gonna have 10% of X. So you're gonna have the rent subtracted by the 10% of that rent, right? So remember that one. So let's do the calculation there. So now we would still have the 107 500, which is equals to 5x. So this is where we do our maths actually. So I'm just gonna be quick with it. So 4x, then this one would be minus 40% x. But now we definitely do know that that 40% we can write it as what? We can write it as 0, 4. We can write it as 0, 4. So you're gonna say 0, 4. Then after that, we're gonna have 107 500, which is equals to 5x plus 4x minus 0, 4. That's gonna be 9 minus 0, 4, and that's 8, 6x. Then if you divide on both sides by 8, 6, then divide on both sides by 8.6 right there. We'll definitely get our x value being what? We're going to get our x value being 12,500. 12,500. So meaning that this is the normal amount of rent, right? This is the normal amount of rent. But remember that from the months that he didn't pay, the rent by that time was reduced by 10%. So meaning that we need to do this. We need to say 12,500 minus the 10% of that what? Of that 12,500, right? And basically, how much do we get there? Right there, obviously, if we subtract everything there, you're gonna get 11,250. So you're gonna get 11,250, and this is the rent that they paid from when it was reduced by 10%. So meaning that now, since we didn't pay for 2 months, what are we gonna have? We're gonna have the total amount for the rent, which is 107,500. Then you're gonna have plus the 2 months that he didn't pay into 11,250 thousand basically. So that is how much the rent income should be for that specific month. And in total, how much are you gonna get? You're gonna get 130,000. So I hope that calculation made sense right there. I don't know if there's an easier one. If you know of an easier way to do this, you can drop it in the comment section. Then I'll definitely see if whether it is an easier way or a shorter way to do it. But if you know a shorter way on how to calculate this, you definitely can go around using that shorter way. But this one is the one that I can go with because it's the safer option, right? So that's basically rent income. So rent income, we are done with it now. We have calculated it, right? So I hope it makes sense. So I'm just gonna erase it because I'm gonna need that space. So if you weren't able to get it, you basically just pause the video and definitely go back to the thingy, to the adjustment or the calculation basically. So yeah, right. So now we continue now. We continue. Stationary. We definitely do know stationary is not obviously an income. So for stationary, we're gonna skip that out. But now there's something I wanted to take. I wanted to show you. Right. We have working provision for bad debts. Right. Provision for bad debts. Provision for bad debts can either be an income or an expense. I've explained it in my video on the adjustments on income statement, so you can check it out to understand what I'm talking about, right? But I'm obviously going to do it again so that you understand it. So, so now, if you look at this adjustment now, it says that provision for bad debts must be adjusted to 4% of the outstanding trade debtors. The provision for bad debts must be adjusted to 4% of the outstanding trade debtors. Now, listen to this part. If your provision for bad debts, if it is going to increase, then it becomes an expense because it means that more people we are expecting more people not to pay. Remember, it's just provision for bad debts, right? It's not bad debts per se that people have not paid. It's just us being like, okay, you know what? I feel like these many people won't pay, or we won't receive this much money. So if that provision for bad debts increases, it becomes an expense. But if we decreasing it, it becomes an income because now we're gonna get our money, right? Because it means that more debtors are we anticipating more debtors to pay us back, right? So now if you can look at this, they're saying that it must be adjusted to 4%. So meaning that from the value that we have, we are just going to drop it to 4%. So meaning that we are decreasing that value for provision for bad debt. So that's why it becomes a what? It becomes an income. So now let's record it. So we're going to have what? Provision for bad debt. So I might not have space. So I'm just going to say prov for bad debts because we're going to need to make a calculation too for bad debts, right? So um let's go through with it and see how we're gonna do it, right. So let's calculate the provision for bad debts now and see how it was adjusted, right? But before we adjust it, be careful because they're saying that we should what? The provision for bad debts must be adjusted to 4% of the outstanding trade debtors, right? So let's go to the amount of our trade debtors. The amount, sorry, the amount of our trade debtors is what? It's your debtors control. It comes from the debtors control right here, which is 382,700. So we'll take 382,700. So 382,700. But now there's an adjustment here which says that a customer who owes 3,700 requested that the balance be transferred to his creditor's account. Yeah. Requested that the balance be transferred to his creditor's account as he also supplies the business with office stationery. So meaning that from this debtors control, we need to subtract that 3,700 because now we are reducing it, right? Then when you do reduce it, what is it that you get? You're gonna get 379,000, right? But you're not done because since this is the new outstanding trade debtors, we're gonna take that value of outstanding outstanding trade debtors, then we're going to multiply it by 4%. And when we multiply it by 4%, what is it that we get? We actually get 15,160. So meaning that from the value right there, we're gonna take the value of the provision for bad debts for 2024, right? For 2024, as you can see here, on provision for bad debts we are given for 2024, which is what? Which is 16,260 minus. Then they're saying that now it is adjusted to what? The value right here. It is less. If you can look at this value is less than the value for provision for bad debts, right? So if this value is less than the provision for bad debts, so it means that, what did I say? I said that if the value of the provision for bad debts is decreasing, then it's an income. But if the provision for bad debts now becomes more than the one from the year before, it is going to increase the provision for bad debts. So that means that it's going to be an expense, right? But since this one is less than the one that we have from last year, it's going to decrease it. So it's going to be minus what? 15,160. Then when you say minus 15,160, we're going to get the answer as what? 1,100, right? So I hope that makes sense right there. So I know it quite was confusing, especially with this adjustment right there of the 3,700 that was requested basically, right? But I hope the explanation made sense right there. So remember, current trade debtors is the value that we use to get the new value for the provision for bad debts. So the amount that it decreased with is the amount that becomes our income, and the amount that it increases with is the money that becomes our expense. So that's it right there. So now I think we should be done with all the adjustments from income. So this one is done. So I'm just gonna cancel it out. Uh, this one is out too, right? So now let's see now. So meaning that now, yeah, now we are done with incomes now. So now since we're done with incomes, we're going straight to our expenses, right? So since we can't record anything here, we just go straight to our expenses. So the first expense here, if you can see, we have salaries and wages. And salaries and wages, it is already calculated right there, as you can see. 1,000,000 and 30, it's already given to us, not calculated, it's already given to us. So now I want us to now move to audit fees now. So you're gonna edit the audit fees. So audit fees are also, it is also an expense, right? So since it is an expense, let's look at if it has a transaction and thingy, it has a adjustment or not. So they say that only half of the audit fees were paid. The balance will be paid in March 2025. So meaning that the balance that's left will be paid in the next coming month, all right? Remember, this year ends on the 28th of February 2025, and they're saying that they're going to pay the full price on March 2025, and they're only saying that half has been paid. So if you go to the value of the audit fees now, the audit fees, how much are they? The audit fees are 45,000. So you're going to say that 45,000, that's already there. But now remember, this is half of the full amount. So we need to add the other 45,000 so that we can get the full amount of the audit fees, which is how much? Which is 90,000 rands. So I hope that also made sense right there. So audit fees we are done. Then now, where do we go after this? We go to director's fee. Director's fees. So we go to director's fees. So director's fees. So director's fees is basically given to us as what? 930, 930,150. 150. So now, I want us to look at something. We need to check its adjustment, obviously, right? So I'm just going to take that on out since we're done with it. So now let's see now. Let's see. Here's the adjustment now. Here. So now they're saying that this one. So they're saying that now the company has two directors who earn the same monthly fees, right? It has two directors who earn the same monthly fees. A third director who was appointed on the 1st of remember, dates are important. Dates are important. I'm sorry for that. So remember that dates are important. So obviously, the moment you see that it is 1st November 2024, you already know that you need to start calculating the correctly, right? Then they say that he earns 4,200 more per month than the other two directors. Then they say that he was paid until the 31st of March. So meaning that we need to reduce his the salary that he received for March, because remember that this income statement ends in February, right? So let's literally do that adjustment and actually see what we get. Now listen to this, right? I want you to listen to this. So I want us to do it carefully together. Now remember, they're saying that two directors, they do what? They earn the same fee. So two directors, they earn the same amount. So the moment you see that two of them earn the same amount, what do? We go and say 2x, because now two of them, they earn the same amount. All right, two of them earn the same amount. Then continuing now, how are we gonna get the rest of it, right? So now we do know that these two did what? These two got paid for 12 months. So we're gonna multiply it by 12. So I know we can put the 12 in front and the thingy. So let me just do it correctly and put it in front, basically. Even now, what's going on now? Look on this side. Okay, thank you. So we'll just write it correctly. So we have 12 into 2x, right? Because remember, two of them earn the same amount, right? But now, remember that there's this one that came in March. No, in November, my bad. In November. So the one who joined in November got paid for November, December, January, February, and March. So he got paid for 5 months straight, right? He got paid for 5 months. And then in that 5 months, so in that 5 months, he got what? He was paid the X amount, which is the same amount as them, but he gets paid more by 4,200. So meaning that he gets to get paid more by 4,200, right? So this whole amount right here is equal to the 930,150, which is right there, right? Because what we are trying to find the value of X so that we can be able to subtract it plus the 4,200 of this person, which is the new employee who was actually employed in November. So let's do our maths here and see how much we get. So we do know that here we're gonna get 24x, then here we're gonna get plus 5x, then plus this one is 5 times 4,200, so 5 times 4,200, and what we get 21,000. So I'm just going to do it quickly and just transpose it immediately. So obviously the positive 21,000, when we transpose it, we're going to have 930,150 minus 21,000, then 21,000. Then how much do you get there? We're gonna have 24, which is 29x. Then it's equals to 930 minus 930,150 minus 21,000, and that gives us 909 150. Then we're going to divide on both sides by 29. When you divide on both sides by 29, the x value becomes 31,350. But now remember that in that 31,350, this is just the x amount that he gets paid, right? This is just the x amount, right? But he gets paid extra by 4,200. So you need to say 31,350 plus 4,200. So plus 4,200. And how much does he get paid? He gets paid 35,550. So that 35,550 is the extra amount that he got paid in March. So we need to subtract it, right, from our expenses because we paid him extra by paying March. So because it ends in February, these transactions end in February. So you're not supposed to include the March part. So we are going to subtract the 35,550, right? So I hope that transaction made sense too and the calculations right there. So at the end of it, this person got paid what? He got paid no, the director's fees would be 894,600. Right. Then that is the director's fee. So I hope it makes sense. But if you have a question on that one, just drop it in the comment section below and I'll explain it better better if maybe there's something that you missed right there. Right. So remember, I'm just erasing because I just need space for more calculations as we continue. So yeah, but that's definitely how we do the director's fees thingy. So we're just gonna remove it right there. Then now, next one that we have, let's just go back. Next one that we have stationery. So stationery, we have what? 63,250. But I think we have an adjustment on stationery. Oh, then now the stationery right there, they say obviously here the stationery meaning that they bought stationery for 63,250. But now, if you can look at this one, they're saying that the physical stock count on 28 February revealed the following: stationery used for the year is 57,500. So remember, since now this one is the one that we use, that's the one that becomes the expense, right? So meaning that for our stationery, we put the one that we used, which is 57,500. So don't make that mistake of putting that one. That one is basically, how can I put it? I also explained it in the video before this one. But what happens is that now when you have bought your stationery for when you in your books, obviously in our books, so this one is our in our books, we have 63,250. But now the book doesn't match the one in our physical the one in our warehouse or in our company, because they did a physical stock count and they saw at the end it's definitely it was not 63,000, it was not 63,250, it was definitely 57,500. So that's why we use 57,500. You don't need to subtract the two, right? I've explained it in my video and that just means so you can go in and check it out to see what I mean by that. But in short, what I'm saying is that since now in our books we had 63,000, but in our warehouse we definitely know that we used 57,500. We are literally going to use the one that is in our physical stock because that's the one that we basically see, right? So that's one thing that you can keep in mind right there. Then now, let's just see if maybe there are more thingies, because now from here, obviously, stationary is the last one. Dividends on ordinary share is not part of the income statement. So the next one that should come up should be depreciation, because now you see it is taken out from the cash flow statement on the 28th of February. So it's still part of it, right? So you're gonna come here and add depreciation too, because remember it's an expense. So you're gonna have depreciation. I also have a video on depreciation. Luckily this time around they didn't ask us to calculate it, but if you don't know how to calculate it, I'll also put the link of the video down below, right? So meaning that now for depreciation we're gonna have 87,600, right? Then we're done with it. Then now let's just see more that we have. So so now we're gonna look for another one, right? Let's just see our adjustments. Here's another one, another adjustment. They're saying that a stock purchase of 13,000 was made on account from Smith and Sons suppliers and recorded correctly. Note, 20% of the stock was defective. The supplier acknowledged the error and issued a credit note, but no entry has been made yet. So now it means that we have a trading stock deficit. Why am I saying that? I'm saying that now because we lost stock basically, right? We lost stock, and there's also a physical stock count that happened. So we need to see if whether we have a trading stock deficit or a trading stock surplus, right? Because remember, if we have more stock in our warehouse, meaning that we have more physical stock than the amount we have in our books, then that is a trading stock surplus, right? But if we have less stock in our warehouse than the one we have in our books, it means that we have a what? We have a trading stock deficit. So now let's check if we either have trading stock surplus or trading stock deficit. So let's calculate it. So now we're gonna go up now to our trading stock. So our trading stock, we have 920,000, right? So at the end of the year, the trading stock was 920,000. But from that 920,000, what happened is that 20% of the 13,000 stock that was purchased was defective, and the supplier acknowledged it, but it was not made. The entry was not made. So meaning that now from that 920,000, we need to what? We need to subtract the 20%. Yeah, the 20,000. So the 20% for 13,000. So we need to subtract it, right? We need to subtract it because that one is defective and it got returned basically. Then now also, how much do we get right there? How much do we get? So I'm just quickly gonna do my quick maths on my calculator. 920,000 minus 13,000 times 20%. And that right there we get 917,400. So this is the stock that we have in our books, right? And this right here, the 890, so we're going to compare it with 890,400. So if you can see the two, this one is the one that is in the warehouse or in our company, then this one is in the books, right? And what did I say about this one? I said if the one in the books is more than the one in our warehouse, that is a deficit. But if the one in our books is less than the one in the warehouse, the amount, it's less than the one in the warehouse, it means that we have a trading stock surplus. So now if we can look at these two, this one, the one in the books, it is more than the one in the warehouse. So we definitely have a trading stock deficit. So we have a trading stock deficit. So in the trading stock deficit, what do? We're gonna say 920,000. Then we have to subtract the 13,000 there times 20%. So 13,000 times 20 percent. And there we get minus 2,600. Then we're going to subtract it by 890,400. I'm just going to complete it there. 400. Then how much do you get now? You're going to have 917,400 minus 890,400. Then in total, you're going to get the deficit that we have is what? 27,000. That's the deficit that we have of 27,000. Right. So I hope that transaction also made sense right there, right, of the trading stock surplus, right? So we're just gonna cancel it out. Then also this one you're gonna cancel it out too. Then also this one we dealt with it, we're gonna cancel it out. Now they also come here, they say the company repurchased. This one is not part of this, so we're gonna leave it for the bank balance sheet. Then also for operating on sales debt equity. So we have used this one, so we're gonna remove it. But the debt equity ratio now shall be used again in the thingy, shall be used again in the balance sheet. Then they say that the loan from King is reduced. This one also goes in the balance sheet. So now, what is it that we are left to do? Now, what's left to do now is that since we're done with everything, we are left with what? With the profit before interest expense, and you also have to find the tax, right? So now, let's see now here. So since we're done with the trial balance, we're gonna come with this one. Income tax paid, we have 130,000 300. Now I want to explain this. I'm glad that this transaction is also there, or this adjustment basically. I want to explain this one because most people never see it. They never understand how to do it, but I'll try to explain it in a very simple way, right, or in a very simple manner. But now first things first, we need to deal with the profit before the profit before interest expense. So obviously for our interest expense, it is literally the interest on loan. I did put that adjustment on my video on the adjustments that we have on income statements. It's actually before this one. So obviously the interest paid here for the obviously the interest that was paid, the interest that was paid just comes there's 22,000 right there, right? Done and dusted. Now let's go to the income tax. let's go to the income tax and see. So now, look at the income tax. They say that income tax that we paid is 130,300. But now let's look at our trial balance. Our trial balance has what? It has credit value. So meaning that we had an opening balance of 34,460 and a closing balance of what? 33,200. So now let's do a T account or a T balance account, right? Like that. Of what? Of SARS income tax. Income tax, right? So we're gonna do a T account for the SARS income tax, right? Because now most of the time we never understand what they're asking us to do basically, right? So now let's record it. So we definitely do know that this side we're gonna have debit, then this side we're gonna have credit, right? So we have credit. So we opening balance. So the balance now it is credited. The balance that was brought down, it is what? It is called. It is going to be 34,460 because this one was the one for the 20 for 2024, right? 2024 when you're closing. But now we paid what? We paid during the year 130,300. We paid 130,300, right? And the balance at the end was a credit. So the balance, sorry, the balance at the end was a credit, right? So it was a credit of what? It was a credit of let me just check the amount again. It is 33,200. 33,200 basically, right? It's 33,200 and it is a carried that this one is the balance that it has brought down. But if you look at this, right, the debit is the amount that we have paid to sales and credit is the amount that we are owing, right? So this is how we would basically calculate the value per se. This is how we calculate the value. Remember, I'm just going to remove this amount here because I need space to calculate. Remember, what do you have? When you are calculating the closing balance, when you are calculating the closing balance, you would have your opening balance, then you would do what? You would add your tax expense. So you'd add your tax expense, right? The tax expense. So meaning the tax that was charged to you basically in that year, right? Then you're going to subtract the payments that you have made. You're going to subtract the payments that you've made, and at the end, you're going to have your closing balance, right? You're going to have your closing balance. So meaning that opening balance plus tax expense minus the payments should give you the closing balance, right? So now let's definitely do it on the right hand side so I can explain. I just wanted to explain the T account here of the income tax. So now let's go into this one and see how we would calculate it. Now, opening balance is how much? The opening balance from 2024 was 34,460, right? Then the tax expense, we don't know it. I'll just say it's X because we don't know how much tax we were charged. But I do know that the income tax that was paid is 130,300. And all of that is equals to the closing balance. And the closing balance was what? 33,200. So obviously, if we just do our maths right here, we have our X being what? 33,200 minus 34,460 plus 130,300, then definitely our X value would be 33,200 minus 34,460 plus 130,300. 130, wait, 3,300. And that right there gives us an amount of 129,040. So it gives us 129 and 40. So here obviously for income tax, so for our income tax would have what? Would have 33,200 minus 34,460 plus 130,300, and that would give us 129,040. So that is basically the value that you'd get for your income takes right there. So I hope that those transactions made sense right there, and that right there is our complete income statement for the year ended 28 February 2025. And I hope that each and every transaction and each and every adjustment that we did made sense. And if you have any question, you can comment them down in the comment section below. Then I'll definitely look at it and try to respond um, as quickly as possible, so to say, right? But uh, now that right there is the end of the video. So that actually brings us to the end of this exam style income statement. So let me know obviously how much you got right in the comment section down below, and if you made mistake, it's okay. That's how we definitely learn. And don't forget to like, subscribe, and share this to somebody that you're actually studying accounting with. And if there's another past paper you'd like me to work through, just drop it below. And thanks for watching, and I'll see you in the next one. And keep practicing.